Next week's budget looks set to give the property market another shot in the arm, with an extension to the stamp duty holiday and now a new mortgage guarantee scheme for first-time buyers with small deposits. According to newspaper reports today, Chancellor Rishi Sunak is gearing up to bring back 95% loan-to-value mortgages by offering government guarantees to banks, incentivising them to carry out riskier lending. 95% mortgages, where only a 5% deposits needed, have virtually disappeared during the pandemic. There were only 8 low deposit mortgage deals available last month. My first mortgage was a 95% loan to value deal. When I bought my first place back in 2002, I was able to save up a 5% deposit by working my socks off selling investment bonds to financial advisors. I bought a 1-bedroom apartment in a market town in West Sussex for £105,000 with a little over £5,000 down. So personally, I don't have a problem with 95% mortgages, but you need to go into them with your eyes open, recognising that there is relatively little buffer between you and negative equity. That's where you owe more than the value of your property, and that can happen if prices start falling. Hi everyone, I'm Martin Bamford, a chartered financial planner, personal finance YouTuber and money author. On this channel, I talk about personal finance, investing and happiness. According to the press reports we've seen today, the government will back lenders, enabling them to offer these 95% mortgages again. This should make it easier for first-time buyers to get a step on the property ladder, where the average maximum loan to value is 82%. What that means in pounds and pence will clearly depend on where you live. As we know, some parts of the country are less affordable, more expensive than others. Also in the press reports, it says that the scheme will be launched in April. It will be subject to a maximum purchase price of £600,000 and it will be open to all types of buyers, not just first-time buyers or those buying new build homes. The latest numbers I can find on this show that the average first-time buyer deposit rose by £10,000 in 2020. In London, it rose by £20,000 to reach more than £130,000. But let's keep in mind that London is an exceptional place when it comes to property prices. According to Halifax, the average first-time buyer deposit in the UK last year was £57,278, up from £46,449 a year earlier. That's 23% higher, or £10,829 more in cash terms. First-time buyers make up a significant part of the property market, responsible for 50% of mortgages last year, with an estimated 304,657 first-time buyers in 2020. This is why government incentives, as they relate to property, often focus on getting first-time buyers into their homes. That, and for a Conservative government, becoming a homeowner is probably correlated with a tendency to vote Tory in the future. Another good reason for Rishi Sunak to target first-time buyers in the budget next week is to help balance some of the economic impacts of the pandemic, which has disproportionately affected younger people. Job losses for younger people are higher than for any other age group, as younger generations are more likely to work in those sectors hardest hit by pandemic restrictions. Regardless of any government guarantee offered to banks backing up these 95% mortgages, banks are not going to lend to everyone. You're still going to need a stable income at a sufficient level to justify the home loan. The amount you can borrow will depend on your creditworthiness, your incomes and outgoings, and of course, how much deposit you have. As a realistic guide, the maximum amount you can typically borrow is 4.5 times your salary as an individual or as a joint salary if you're buying as a couple. However, some first-time buyers can borrow as much as 5.5 times salary, but do keep in mind this is the maximum. You have to think about affordability. While the bank or building society will be running its own checks to make sure you can afford the mortgage both today and in the future should things change, you need to be sure of this yourself too. A reasonable budgeting rule of thumb is called the 50-30-20 rule, and this says a maximum of 50% of your net income, that's income after tax, should be spent on your needs, with 30% on wants and 20% on the future, so savings and investments. If you follow the 50-30-20 rule, that suggests spending no more than half of your net income each month on your housing costs, along of course with everything else you need in your life, including utilities, food, insurances, transportation. Think very carefully about this stuff before taking on the financial commitment of a mortgage. Interest rates can go up as well as down. Your circumstances can change. There are risks risks, of course, you can insure against, including loss of income due to an accident or sickness, but that doesn't change the fact that you have to keep on paying your mortgage each and every month. There are pros and cons with a smaller deposit, a 5% deposit. Putting down a smaller deposit is unlikely to give you access to the lowest possible interest rates, and as I mentioned earlier, it gives you less of a buffer against negative equity, owing more than the value of your home should property prices fall. But in an environment where the average first-time buyer deposit is almost £60,000 and where property prices are continuing to rise, you risk chasing a continually moving target when you're saving for a deposit. You need to seriously question whether your rate of savings is high enough to catch up with the amount you need to save for a deposit before it goes up again in line with higher property prices. If you can step onto the property ladder sooner by virtue of only needing a 5% deposit, and you can save some money assuming the stamp duty holiday gets extended too, then that might not be the worst financial decision in the world. But as I said earlier, be mindful of the risks involved, falling into negative equity if the market drops, and not being able to access the best possible interest rates. What do you think of this expected government support for home buyers and the wider property market? Let me know in the comments. I'd love to hear what you think about this one. One quick request from me before I finish: please hit the subscribe button, join our subscriber community before you leave this video. I bet my 12-year-old nephew that I could get to 2,000 YouTube subscribers by the end of this month, and we are so close. So please go on, press subscribe. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.